Welcome to the Clark Howard Show, where our mission is to serve you and empower you to make better financial decisions in your life. Clark's voice has not changed. Clark is out today. This is Christa. And Clark will be back tomorrow in time for Clark Stinks. He would not miss that for the world. We get so many investing questions on the show that I thought we'd bring back our friend, Wes Moss. Wes is a fiduciary financial planner that Clark and I have known like forever.
And a long time.
And you were on the show with Clark not too long ago. And so I thought this would be a good opportunity with Clark skipping, playing hooky today, to bring you in and have you give some of your awesome knowledge and also answer some of these investing questions from a financial planner's perspective.
I'm excited to hear the questions. I'm happy to help, and you and Clark have been so great over the years. You've helped me with my podcast. I've looked up to Clark for almost 30 years. So really, he's been my radio and financial mentor for so long. So it's great to be here to help.
Well, awesome. And I know, so we're gonna get to those questions, but you have an issue with an article you recently read, right?
Every so often, first of all, I love the Wall Street Journal. I think they're balanced. I think they're smart. Their reporting is good. Every once in a while, they will take a shot at a time-honored investment strategy and cast all this doubt in the world. And I think that can actually do a lot of harm. So I'm going to talk about this article and I would call these two on the Mount Rushmore of financial planning. There's call it 4 or 5 really important rules of thumb. They just blasted 2 of them, and I have a real issue with it. And we're going to talk about that today.
Awesome. All right. Well, so you're going to talk about that, like 2 different parts of that. First, in part 1, you'll do, and then we'll get to some questions. So
let's do it.
Go for it. I can't wait to hear.
And the questions are from all over the country.
Oh yeah, always.
All over.
Yeah.
So part 1 is this: again, Wall Street Journal article taking a shot at 2 of the most fundamentally important financial principles that I think there are. They're not the only 2 that make retirement work, but one is them taking a shot at and saying that this time-honored strategy, if you still follow it, which is the balanced 60% stock, 40% bond portfolio, it might not work in the future, is what they're saying. So that this time-honored strategy may leave you in financial ruin. So my initial, which is saying that a balanced portfolio over time just might not work. And to say that is, and really they don't have any really good reasons about it. They're saying that, and let me describe a balanced portfolio. When we say a 60-40 balanced portfolio, it means approximately 60% in stocks and 40% in safety assets or bonds. And it's a shorthand way, this 60-40 portfolio. It's a shorthand way of saying, how do you get the most amount of return with the least amount of bumps along the way? And it is really difficult to do that if you are 100% in stocks, because then you run the risk of huge drawdowns. We've had several over the last 20 years where stocks will go down over 50%. And that can be really detrimental, particularly if you're heading into retirement. If you're 100% in bonds, then you really do cap your long-term compounded rate of return. And a lot of people can't retire by just saving in bonds. So for the last 30 or 40 years, the concept of putting 2 pieces together, 2/3 in equities or stocks of the stock market, has been the engine and perhaps the best antidote to outpacing inflation or protecting your purchasing power. And on the other side of that balance, the safety side or the bond side, that's there to get you through those really difficult times that most investors cannot just handle 50% down at any given time. So the buffer, or the 40% in a balanced portfolio, is meant to be stable. And so what the article is saying is that bond yields are relatively low, so maybe bonds don't do all that well. And there's plenty of problems in the United States, like the national debt and the price to earnings ratio for the Shiller earnings ratio is high, so stocks might not do all that well. So there's this blanket statement that really the world's just not going to do all that well moving forward. So this time-honored strategy, maybe it won't work. And it's possible that that's correct. It's possible that the United States stops being the most productive economy in the world and our stock market never goes up again. It's possible, but it's not probable. And the thought that you have to try some new gimmick to figure out a way to retire now because the sky's a little cloudy. By the way, the sky's always a little cloudy. Really doesn't make any sense. And the fear I have when someone like the Wall Street Journal says, hey, throw out a really fundamentally sound financial principle like a balanced portfolio, is that I think it could be really discouraging for those who are trying to get to retirement. And they kind of throw up your hands. You say, well, if that doesn't work, then I'm not even going to get started. And my message around that is that I think it still does work. I think a balance is our friend. I think 2/3 in stocks, and everyone's going to be a little bit different, or maybe a lot different. But I still really believe that having the majority of your assets, more than 50% or more than half in stocks, is still perhaps one of our very best ways to protect our purchasing power and protect against inflation. And B, on the other side of that, I love the stability and the income that can come from the safety side or the bond side of the equation. But really the power is that together, so that in times of difficulty for stocks in the economy, your portfolio stays on a much steadier trajectory, and it allows you to sleep well at night and stay invested. And really, one of the primary principles about being an investor is to not get scared out of investing. And I think a balance is our friend. And so I still believe in the 60-40 or 70-30 balanced portfolio. I think it still can be a critical component for so many Americans. And I just wouldn't flush that down the drain so easily.
All right, so you ready for some questions?
Yeah, go ahead.
Okay.
Let's do them. Let's do it.
This one came in.
Can we start with the easy one first, or we go right to the hardest one? Or do you even know which one? Which ones do you think are the most difficult?
I feel like they all might be.
Okay.
Not for you. Definitely not for you. All right, Kevin in Oklahoma sent this one in. I work for a large midstream oil and gas company. One benefit is that employees get one free share when our company stock closes at a record high. These shares are put into an account that we all have full control of, and we can sell the stock or just leave it there. We've received 8 shares in the last 6 months, currently worth around $800. My question is, should I just leave the stock in my account, sell it and invest it? I do have a pension and a 401k as well.
Okay. So first of all, I don't know the company, so I'm not
Right.
commenting on the stock. I do love the oil and energy sector. So the energy pipeline sector in America is a really unique part of the oil industry in the United States. It's not so much about getting oil out of the ground. It's really the transportation of oil and energy. So it's something that it's not going away anytime soon. So I like that sector. I don't know what the company is. I think it's pretty cool that they give away shares when the stock does well. So that's a really nice benefit. I haven't heard of many companies doing that. So that's great. So what do you do? What does Kevin do with these new shares? First of all, the one foundational principle about investing is that we don't want to get overweighted in any one particular company. We've got to be very careful about single company risk or single stock risk.
Right, especially if it were to be part of your retirement picture, for sure.
Absolutely.
Yeah.
And by the way, the energy sector can be pretty volatile too. Mm-hmm. It's not known to be one of the most stable places, stable industries.
Yes.
So it's very there's a little bit of a roller coaster impact. But as long as this doesn't start to make up a huge percentage of Kevin's overall net worth, I think it's fine to stay invested and hold those shares. However, if we go back to what works over time, one of my guiding principles is broad market exposure as opposed to single company exposure. And when's the best time to do that? It was always yesterday. It's always, in my opinion, good to be diversified in a broad equity market or stock market sector. So I think it's fine, particularly with only a few shares here, that Kevin holds on to this and he has some real, if he feels as though he's got some real tie to how the company's performing. But in the end, really what we need is exposure to the total market.
Right.
So if I were him, I'd probably be every year or so look at that amount and say, That may be better in a broad market index. You take your shares, and now you've got the diversification you need, because that's what matters getting to retirement.
Okay, this is from Sherry in Colorado. My wife owns her own business and has 2 employees, myself and her mom. I have another job that allows me to fully fund my 401k. We are trying to determine how to save for retirement. She makes too much money to invest in her IRA. She has a SEP created prior to having employees, but using that would require her to put the same amount in for both employees. What type of account should she be putting money into?
There's a lot of retirement plans going around there. There's the 401k for Sherry's wife, and then there's her business. There are a couple of options here. One, if they're looking at this as a whole family, so Sherry, her wife, and her mom, then the SEP may be okay, up to 25% of compensation. The problem with that, and why it's hard for business owners to do a SEP, is that if you choose to put, let's call it 20% of your compensation away in a tax-deferred retirement account with the SEP, then you've got to do it for everybody. And that can get really expensive, particularly as the number of employees grow. So if they're looking at that, if they're looking at it as one big family, maybe the SEP's okay. But it sounds like they do things separately. And for mom, she's doing her own retirement planning. That would lead me to perhaps a solo 401k. So a solo 401k obviously could be for one person, and that one of the caveats to that is also a spouse. So maybe if mom is just a 1099 employee or a part-time employee, Sherry and her wife could just use a solo 401k. Contribution limits are pretty high there. If they're 50 plus, it's $30,500 plus 25% of compensation. So that's another, could be another $25,000 if she's making, let's say, $100. You're talking about over $50,000 per individual. And I'm also assuming that the job that Sherry's wife is doing elsewhere is very different, or a separate job, and it's not just a spin-off in Sherry's company.
Yeah, that's what it sounds like for sure.
But both of those could be a little bit complicated, and I think maybe there's a happy medium here, and that would be what's called a simple IRA, which stands for Savings Incentive Match Plan for Employees. It kind of gives a happy medium here where the contribution limits, again, if you're 50 plus, or call it right around $22,000 a year. So you can defer $22,000 of your income. Your employees can do the same. And for the employer, Sherry's wife, she only needs to put in a non-elective 2% of income. So it's not that expensive as a company putting retirement savings away, or a 3% match of what, in this case, mom is putting away as well. So I think that if I'm thinking about all the different options here, whether it's a SEP or a 401k, solo 401k, I think the simple IRA, which can be set up at Schwab, Fidelity, Vanguard, might be the answer here, and something to explore.
Awesome. Okay, well, coming up straight ahead, your second beef with this Wall Street Journal article. I can't wait. Can't wait to hear it. All right, we'll be right back. All right, we're back. And Wes, let's hear your second beef.
So again, we're looking at a Wall Street Journal article that recently said that if you follow these 2 time-honored retirement strategies, it can leave you in financial ruin. So I thought, wait a minute, what could these be? Well, the first shot they took was a balanced portfolio just might not work in the future anymore, which I think is crazy talk. The second has to do with something I think this is a sensitive topic that's near and dear to everyone's heart. And that is, what's the maximum amount of money I can pull out of my retirement savings without running out of money? And there's been a lot of study and work around this. And that has landed, and what I've utilized for the majority of my career is something called the 4% rule, which is you're allowed to, this is a very important rule of thumb, where if you over the course of your 20, 30, 40-year retirement, take 4% of your initial balance and increase that every year for whatever inflation is, as long as you have a balanced portfolio, by the way, you have call it 99% chance that money won't run out for at least 30 years. And in most cases, it lasts 40, 50, 60 years, so almost indefinitely. So it's a really important rule of thumb. But it gets attacked all the time. And I went back, I did a search for 4% rule bashing. And it seems like every year there's at least 1 or 2 articles that says, well, the 4% rule doesn't apply anymore. Well, in this latest article, it's saying that 4% rule might not apply anymore because in the future, stocks might not do well and bonds might not do well and inflation might be really bad. So you can only use 2.25% of your money. Wait, 2.25%? So that means on $1 million in savings, you could only safely withdraw in year one $22,000 or so, $22,250, and then that can ratchet up for inflation. If you have $2 million, that means you can only take out about $44,000 in your initial year, and then ratchet that up for inflation. That number is so low that I think it runs the risk of people saying, "What's the point? I mean, if you can't use your money, if you can only use 1 or 2% of the money that you save, what is the point of saving for 30, 40, 50 years if you can't use it?" So it is, to me, I've gone back and my analysis team has rerun the 4% rule, which starts back in the 1920s and projects out to today into the future, looking at actual stock market returns, actual bond market returns, and then having really conservative assumptions for the future. And from everything I can tell, using the 4% rule, which is 4% of your initial balance plus inflation every single year over time, still works 99% of the time. And that's if you're testing it to last at least 30 years. So the worst outcome over this almost 100-year period of time has been money only lasted 30 years. And then the next few are 35, 36, 37 years. So from everything that I can tell, and I've tested this over and over and over again, the 4% rule still should be a really good guide. And I think if you stomp on that, you're just hammering the confidence of every American that's trying to get to the same spot, which is financial and economic freedom and to be able to stop working and then have their money work for them and use as much money as possible. So max out your withdrawals without running out. And I think the 4% rule still really works, even though the Wall Street Journal says, well, maybe it doesn't. I totally disagree.
In fact, I remember on your podcast one time you said, well, this was a couple of years ago, but like that it could be 4.5%.
The godfather of this rule is named William Bengen. He was an MIT guy, aerospace engineer turned financial advisor. Mm-hmm. And Bengen did this initial research. This goes back 30 years. Over the last couple of years, he came back and had an interview with Barron's and actually upped his withdrawal rate to closer to 4.5%. So I think that, and now he added a few other things. He said if you add a small amount of small companies into the mix of that balanced portfolio, then you could essentially use 4.5% as a guide, which is a lot more than 4%. Mm-hmm. So even Bengen's coming back and saying maybe it's even 4.5%. So when I read an article and they suggest it should only be 2 or 2.25%, it just seems like crazy talk to me.
Yeah, that's
depressing. And it makes people quit before they even get started. And that's the last thing we want to do when it comes to retirement planning.
All right, well, we'll go to some questions. This one is from Juan in Connecticut. He said, is it possible to withdraw contributions from a Roth IRA without penalty, or do I need to wait until I'm 59 and a half to do so?
Juan, here's the good news, when you're putting money into a Roth, you're putting after-tax dollars into that Roth. You've already paid taxes. So when it comes to your contributions, you can pull them out tax-free at any time with no penalty. You don't even need to be 59 and a half to do so. So I think this is good news here for Juan. Now, it's a little different story when it comes to earnings. So let's say you put $10,000 into a Roth. Now it's worth $15,000. Contribution is 10, so you can take that out. But in order to access the additional 5, so the full 15, that you've got to satisfy 2 rules. One, it has to be in there for 5 years or longer, and 59 and a half if you're looking to take out the contribution and earnings without penalty.
Awesome. Okay, and this one came in from Ken in Virginia. Clark, I'm looking at converting my IRAs and a 457 account to Roths to eliminate RMDs and the risk of RMSs kicking me into a higher tax bracket and IRMA risk. A company, I'm not going to name the name, is offering me a plan to convert my IRAs in 457 to a Roth by investing the funds in annuities with insurance companies that offer a bonus, in quotes, that covers the taxes and have floors so that, quote, you never lose money. The annuity provider charges a 0.95% annual fee. Is this a good plan? What are the downsides? I know Clark doesn't like annuities as a rule, but is this an exception? What do you think, Wes?
This is great because he's just asking about it sounds like the perfect product. So this is what they're saying. So first of all, I think it's important to remember that anything in any one of these equity-linked, equity-indexed annuities, they're technically not investments. They're insurance products. It's an insurance contract. It's a contract that you have with an insurance company that there's some sort of payment component, so you can think of it as an investment. Really, it's an insurance contract. So that's number one. Number two, what's described here is sounds like the perfect investment. There's no downside risk. It'll also get market returns. That right out of the gate sounds amazing. Not only will it do all of that, but it'll also pay your taxes for your required minimum distributions way out into the future. I can't imagine that anything this magical, too good to be true, exists in any way, shape, or form. Anytime a company is saying that they're going to give you a bonus that is going to just pay your taxes, the taxes on your required minimum distributions from your IRAs, that to me just sounds very suspect and not transparent. And very often when investors think of these as investments, they're mischaracterizing what's usually a 150-page prospectus that's really an insurance contract. So and in my opinion, the best way to go about knowing that you have to pay RMDs, and RMDs are a very real issue, required minimum distributions out of your IRA. If you have a $100,000 IRA, your first RMD is going to be around $4,000. On $1 million, now we're talking about something like $40,000. The IRS is saying you've got to pull out of the account. It gets counted as income. It can do all sorts of things like increase your overall tax rate. It can bump you up when it comes to your IRMA for Medicare. So there is this thought that converting into a Roth can help with that. Converting into a Roth, though, should be taken very seriously. It can work and it can make sense, but it's all about taxes today. What am I going to pay to get money out of a retirement account into a Roth? It's going to cost whatever comes out of that account. If it's $100,000 and you're converting it, you've got now $100,000 of new income on top of your current income. Imagine what that does to your tax bracket. So if you think in the future your tax bracket will be higher than it is today, maybe it makes sense. Maybe you're paying today at 20, but you think in the future it'll be at 25. Maybe the conversion makes sense. But that's also a different story. The thought of a product paying for all of your taxes in some magical way through a bonus, which, by the way, when you read the fine print, usually you can't access that bonus except for over your entire lifetime is usually how those work. It's not like I can just get the bonus today and pay the taxes. It just doesn't work that way. So I would take the conversion to a Roth very seriously, particularly if it's a large amount of money, because it can dramatically increase your taxes in any given year, number one. Number two, I'd be very careful and very leery of an insurance product that promises to pay for all of it. Sounds too good to be true. And when it sounds too good to be true, when in the world of finance, it almost always is not true.
Okay, well, that is it for today. Thank you so much for joining us, Wes. You're a gem. We have info in the show notes on what Wes talked about and how to reach him. And you have a lot of great info on your website too. And Clark's taking another day off next week. So while we're here on video and audio, I want to ask if you'd be willing to come back and answer some more questions.
If the questions are like this, I'll come back anytime.
Oh yeah, we have plenty of investing questions.
Love it.
Clark will be back tomorrow. We're going to do Clark Stinks. And have a great rest of your day. Thank you so much for joining us.